followed by grain, followed by livestock. So we'll begin showing you cotton prices going back a good ways, going back to really the previous season. Even though this is the current harvest time futures contract price, but a year ago we were at very high levels from other dynamics going on, and I think those dynamics have been over for a long time. So if you go back just a year, back to last November, you can see that we've been in a sideways gyrating pattern that we're still a part of. The range has shifted higher, it's shifted lower, up and down. Earlier in the fall, in August and September, we were in the upper 80s, bouncing off 90 cents a couple of times. And then here recently, like 3 weeks ago, we just took a slide for no particular reason that I could name for you. Um, I know there was speculative selling going on. I know that there was some discussion about poor demand, but it's still not really clear to me why prices fell from the upper 80s all the way down to about under 75. But they did, and there's that slide. And if it did anything good, it's kind of like drilling for oil or drilling for water. We found demand. We found a boom in export sales when prices dipped under 80 cents and down to the mid 70s. We had the highest weekly export sales numbers ever at the bottom of this price decline, and we've had 2 or 3 weeks of good export sales following that. So there is apparent export demand for U.S. exports down here. So the long and the short of it is, what I expect to happen is, having established price support at the bottom of this drop, I think we're going to bounce around now for the next couple of months, probably within this range. We were a little under 80 cents or around 80 cents this morning. Um, we may get up as high as 85 or so, but I think we're going to continue in that range there. Let's look at some of the supply and demand reasons for why prices are doing what they're doing. This last column here on the right is USDA's November numbers for the 23 crop. And what they basically did was they tinkered with the production a little bit. They actually raised production for the first time in 3 or 4 months. They had been trimming. They had been taking big downward adjustments in August, and then a smaller adjustment in September, a smaller cut in September, and then even smaller cut in October. And then in November, they actually bumped the number back up 200,000 bales, which, if you're in Texas, you might find that surprising, but basically they're still cutting in Texas, but they're finding strong yields and more bales than they expected over in the Delta and other places. And so the net effect was a 200,000 bale increase. So we're dealing with a crop of around almost 13.1 million bales. The only other thing they did to the U.S. numbers was trim domestic use. They cut that 100,000 bales, and so the end result down here at the bottom, where it says 3.2, that's 3.2 million bales of ending stocks, leftover stocks, carryover stocks. And compared to the previous month, that number has risen 400,000 bales, which is kind of bearish, moderately bearish. And so what I expect to happen is, they'll probably do a little bit more trimming with this production number. First they cut it 2.5 million, then they cut it 800 and something thousand, then they cut it 300 something thousand, then they raised it 200,000. I wouldn't be surprised if they lowered it or raised it another 100,000 between now and New Year's. And that fits the general pattern of adjustments in USDA's estimates of cotton supplies. This is the August report. There's a wide disparity of the difference between the guesstimate and the final actual number is pretty wide. It ranges from negative 10% to almost 20% up there, and that it shrinks. That's what this chart is to show you. USDA zeroes in when you get to September, October, November, December. Their estimate of what the crop size is it zeroes in on what the real number is, typically by about January, and that's probably what's going to happen this time around. So the long and the short of that is, as far as prices go, is that I don't think there's very many more surprises left in the size of the crop. So I don't think there's going to be a supply side rally that's going to take us over 85 cents. I think we're zeroing in on what we've got. And as I mentioned earlier, the demand appears to be supportive, at least in the lower 75-cent range. So we'll probably be bouncing around somewhere above that range. And as I think about next year, then the question is, well, this year, as Rick Ackerman just remarked to me, is kind of a kick in the teeth. It's not the recovery year that people wanted. So how excited they're going to be about planting cotton next year, that kind of remains to be seen. The only thing that might encourage planting cotton is the bad news that Dr. Welch is going to tell us about corn prices. So I've got a couple little historical models that might suggest that we plant at the moment, given where prices are, new crop prices, we might plant around 11 million acres. But if we do that and we've got decent moisture, we might have a 15 or 16 million bale crop, and that may be more cotton than we need to hold prices in the upper 70s. What I'm trying to say is I'm a little bit more concerned for this next year about somewhat lower prices than we've seen in a while. Futures in the mid to lower 70s and cash prices several cents below that. So of course, that's a long time away, so we'll have to see how the acreage expectations pan out. But like I say, I'm a little bit more worried about. I think the old crop prices are going to hang in there between 75 and 85, and the new crop prices, I'm a little worried about more downside pressure for next year. And Pancho, that's all I got. So I'm going to have to get off the call. But if anybody wants to call or chat or email, feel free to do that. And on a completely different subject, everybody should have gotten their county increment report stuff emailed to them, either email to the county office or email to the A&R agent. If you didn't get it, send me an email and we'll get you taken care of.
Thank you, John. I appreciate.
Yeah, thank you.
So Mark, whenever you want.
All right. Yeah. Let's see. I'm still seeing John's content there right now.
Oh,
John,
sorry.
Can you stop sharing?
Yeah, just a minute. I'm going to leave.
There we go.
Okay.
Let's see if I can find the correct window. Let's see. And the slideshow from the beginning. All right. Well, good to be with y'all this morning. Again, Pancho, appreciate your organization of getting this thing together for us every month. Got a couple of red flag kind of warnings on the grain markets. I think there's perhaps some positive news. May kind of take a little bit to get there, but we're certainly going to work on both sides of kind of what that expectations might be for the 24 wheat crop. And then I'm going to touch on corn, and then glad to take any comments or questions around, say, grain sorghum or something like that. First of all, looking at price activity, these are Texas cash grain prices going back to the summer of 2020. So we're about 3.5 years in on this price chart. And the story I'm trying to tell with this is that those factors that got us to these really high grain prices have pretty well resolved, other than we still have Russia with its ongoing military action against Ukraine. But even with that going on, we have settled grain prices now back to where they were in the fall of 2021. And particularly of concern, if you note kind of where the relationship of those prices are today, and that's I color-coded those prices where they were last week, and that's not a mistake when you see the price of wheat below the price of corn in the cash markets around Texas. And that's not a good sign for our wheat market. Well, even for our grain markets, it's increased feed. That means we got wheat as a feed grain is what that means. And so you've got more competition in the feed grain market. And then that typically is an indicator of what poor export demand we have going on in the wheat market that for higher levels of usage, more as a food grain. And that's not what you want to see for winter wheat. So that's certainly a price relationship of concern and a demonstration of just some weak demand that we're seeing in that wheat market. Now, the good news on the horizon for all grain production, particularly in Texas, but the Southern Plains in general for 2024, is that we are currently back in an El Nino weather pattern. And that's demonstrated on this chart of these actual measurements of sea surface temperatures out in the Eastern Pacific. Whenever that's a 0.5 degree centigrade above normal, then that's when you enter the El Nino zone. And we're still kind of on the front end of that. It takes 5 of these 3-month periods to consecutively be in an El Nino, and 5 obviously on the La Nina side as well when it's below that 0.5 degree centigrade temperature. But we still got a few months ahead to the peak of this current cycle before it starts to fade then by the time we get into late spring and early summer. That's typically a favorable weather pattern, again, for the Southern Plains. And if you'll note the forecast, if we do reach that 2-degree temperature deviation, that would make this the second strongest El Nino winter since 2000. And the last time we had a stronger El Nino than this one, in 2015, 2016, that's the last time we set record high wheat yields in this country. So again, typically that moisture pattern and temperature patterns associated with El Nino weather phenomenon are very favorable for our winter wheat production. And then that carries over into our spring crops as well. And this global impact chart, I think it's important. And of course, I want to focus on the U.S., that wet and cool period, particularly January to April, just sets us up for a good wheat crop and usually in good situation for going into our spring and summer planted crops across the southern U.S. But I also want to note where you might look at some areas of concern based on perhaps your particular commodity of interest, or where you might see export competition for those, again, those markets in which you're paying particular attention to. When it comes to an El Nino pattern being favorable for grain production, we look at Argentina and southern Brazil. Typically, they would have a very similar kind of reaction to this weather pattern that we have in the U.S. Where is it typically drier? So the opposite effect. You would look at places like northern Brazil. That could certainly have implications for our grain markets. Australia, big competitor in the wheat market. Southeast Asia, they produce quite a bit of corn in Southeast Asia. They import a lot of grain in this part of the world. So that could have some significant implications. Southern India, perhaps wetter, but then you look at the rest of South Asia, and again, that can create some very dry conditions in that part of the world. And we do get some export competition out of South Africa when you look at the corn markets. So again, this could set us up for perhaps an increase in export demand if we happen to see some production problems or increased import possibilities based on what's going on in some of these areas with whom we compete in the global marketplace. The wheat market, the reason I put this chart together is this is in a nutshell what I expect for Texas wheat production reflected in USDA's long-term projections for 2024. Again, this is not an official forecast, but the numbers that came out in the first week of November, their models would estimate that compared to 2023, we may see fewer wheat acres planted, but we're going to harvest a higher percentage of those. That's exactly what I expect in Texas. I don't know if we'll plant the same number of wheat acres we did a year ago in Texas, but I think with better growing conditions, we're going to harvest a much higher percentage of what we plant and see a rebound in yield on those harvested acres, increasing the supply of wheat. The challenge will be, we'll be able to keep up the use side of the balance sheet. That's going to be a challenge given the degree that the potential is there for an increase in supply. In this particular projection, there's a 200 million bushel increase in supply, and we've only increased 100 million on the use side, and that's better exports, but again, creates some real challenges for us. And that carryover then starts to go from instead of the stocks to use ratio, I like to use days of use on hand at the end of the marketing year. We go from 112-day supply to 134-day supply. then we continue to build those supplies into the next year and the downward pressure that has on prices. For corn, if you look at what's happened, our experiences for this 23 crop, it's absolutely incredible to me, given the large portion of the corn belt that was under dry and significantly drought impacted growing conditions all season. And it still looks like we're going to come up with a national average corn yield of about 175 bushels. That's just astounding. And given the increase in acreage that we had for 2023 compared to 2024, we're looking at an all-time record high corn crop and supply then up about 10% compared to where it was in 22. But we got the same problem in the corn market that we're talking about in the wheat market. That increase in supply was not matched in a concurrent or a level of demand or use at that same magnitude. And even with an increase somewhat in domestic use and even bouncing back some projections for higher exports, we're only looking at a 5% increase in use relative to a 10% increase in supply. And that's when you get that price impact of a 25% decline in the price, the season average corn price. That's the national average price paid to all farmers in the marketing year. I'm going to show the impact of that here in just a second, but note that ending stock number before we move on. That's pushing our ending stocks or the carryover number, the beginning stocks number for the 24 price projections, that balance sheet up over 2 billion bushels. And we'll talk about the magnitude of that here in just a second. So let's go from a 36-day carryover to a 54-day carryover. What's the price implication of that? Well, it's moving us from below that 40 days, which is relatively tight supply and demand conditions. Now we're pushing pretty far over here to the right. Days of use on hand at the end of the marketing year in that mid to low 50s. You would expect cash grain prices in that $4.50 to $5 range. And that's just kind of about where we're landing here as we get to the end of the 23 growing season. These prices in these other years in the biofuel era, these have been adjusted for inflation. So those are prices at that time reflected in 2023 dollars to account for the higher cost of production and just what those prices look like in today's economic environment. So that's pushes pretty far to the right. Here's what happens when you have beginning stocks over 2 billion bushels. We haven't seen that since 2019. We had 3 consecutive years of beginning stocks of 2 billion bushels. And of course, what that does is you've got that supply cushion. So if there's an acreage shift or a production problem, you've just got more cushion or more reserves to guard against the price increasing impact that supply situation might bring. And you'll note that anytime in the last, in this biofuel era, that we've had that 2 billion bushel carryover, again, these are in current prices. The price of corn that season was around $4.30 to $4.50 a bushel. A strong price depressing effect when we have a carryover over 2 billion bushels. This chart only goes up to 2.5 billion. Make a note of that from what I'm fixing to show you in these next projections. So starting the year with a 2 billion bushel carryover, we could cut acreage back, say, to 91 million acres. Again, these are projections. These are not an official forecast. A 91 million acre crop and a trend line yield estimate of 181 bushels, where if we repair the drought in the Midwest and have kind of a normal growing season, that is a national average yield that will be well within grasp. We're looking at an actual lower production number of 15 billion bushels, but you add in a 2 billion bushel carryover. Now we've got supply for the new growing season in 2024 of over 17 billion bushels. That would be an all-time record high, even though we're bringing in a smaller corn crop, given this kind of acreage and yield. And again, we're struggling on the demand side, particularly with export competition coming out of Brazil, China buying much more grain out of South America. We could bump up domestic use, primarily feed, if we see some rebound in the 24 and 25 marketing year. But still, we're looking at use only up 1% relative to that 3.3% increase in supply, given this scenario. And here's where it really gets scary. Ending stocks from 2.2 billion to 2.6 billion. previous chart only went to 2.5. We haven't seen a 2.6 billion carryover since the late 1980s. Carryover to use, days of use on hand at the end of marketing year. If we thought 54 was high, push that number out to a 66. What does that look like on our price chart? Yeah, we're way out here. So again, that price depressing effect that large carryover starts to have in our markets until we have a significant shift in acres, a production problem in a major producing area, whether it's for export demand or here in the U.S., and that could happen, obviously. But given normal kind of conditions, I think this is the kind of situation we need to be aware of in terms of possibilities. Now, if you're talking to a grain producer, a corn producer in the state of Texas, you tell them the price of corn a year from now is going to be $4.50 a bushel. I don't think you will find very many producers that would tell us that you can make any money growing corn at $4.50 a bushel. And I certainly wouldn't argue with that. I don't know how you do it at $4.50 a bushel, which raises the question. If you can't grow it for $4.50 a bushel, the current December contract is still trading over $5. And if you have a positive basis in your area, say 10 or 20 cents, and you can lock in $5.30 or $5.40 on that 24 crop, given the prospects or the possibilities of seeing a $4.50 price, perhaps that would motivate some conversation around having a marketing plan and some marketing incentives built in to what the prospects might be. Again, these are projections. That's not a forecast. That's just one alternative scenario from the models of USDA. But I think it's one we need to look at conditions that might lead us to that kind of outcome. And as we evolve through the winter, planted acres, growing conditions, crop conditions in South America, does it lead us more toward this kind of outcome or make that less likely? I think those are conditions we need to monitor. So obviously we're still in a very high input cost environment when it comes to all of agriculture, interest rates, as well as everything else that were your input cost. Particularly on the demand side, I think the impact of slow economic growth, recession is not out of the possibility for 2024. And certainly that keeps us in a tight margin situation, high cost, lower prices. So much though rides on the global economy, global trade, our export competition, as well, of course, any disputes and disruptions and the uncertainty around that. And then, of course, the weather. So that's what I brought to share today. Again, I think there's some areas of major concern for prices for 2024, but that doesn't mean there won't be opportunity given what is still a very volatile pricing situation when it comes to grains. So Pancho, again, good to be with you today. I'll try to close this down and hang around for any questions or comments that may come along.
Thank you, Mark. Very interesting. Scary too, but very interesting. Any questions for Mark?
I do have a comment, by the way. This is Yuri. I do not have camera. Just a good news probably for the corn producers, because in Brazil, a lot of people are losing the soybeans. After 20 days of dry temperature, the seeds die on the ground. So we're gonna be a severe problem with soybeans, but they are replanting soybeans. What's the effect for corn? Brazil has a strong after soybean, they plant the bulk of the corn production. Yeah. So if we are replanting the soybeans now, probably or almost certainly our corn season will be way less than the last year. So that's a good news for corn market.
I couldn't agree more, Yuri. And the implications of that is, and you'll be more familiar than I with those as those one crop affects the other. If the soybean crop is late, it comes out late in February and March when we try to get the corn crop planted in a timely manner. Because again, that's our export competition out of that secondary corn crop in Brazil. So now the corn goes in late and it's not in the optimal planting and growing conditions. Does that then limit the productive capacity of their export crop? So yes, it's a cascading effect that could support our corn markets. And if I'm looking for something positive in the corn, it is competition for soybeans. The demand undertone for soybeans looks much stronger now than for corn. The price relationship of soybeans relative to corn in the U.S. tends to send a market signal for farmers to make that shift in acreage. So yeah, I think we can see a big shift back to beans in the U.S. And if we're seeing that globally as well, that may constrain the corn supply for a couple of reasons, of which you've noted here this morning, that could be supportive to those grain prices, corn prices in particular, as we get through the growing season in 2024.
Excellent. Hey, thank you, Mark. I appreciate it. If there is no more questions, David, whenever you want to start yours presentation. Mark, can you stop sharing? Thank you.
Look okay?
Perfect, yes.
Great. Well, again, like everybody, thanks for having me with you, and I'm going to bring us home with maybe a little bit of good news. We'll see. Let's jump right in. I really want to focus a little more on cattle today than most other stuff. If we look at these are fed steer prices, Southern Plains, feedlot sales going to a meat packer. We have seen some a fairly sharp decline in prices over the last couple of weeks. Really, if we look back at the futures market, really not since the cattle on feed report that came out last Friday, but the one before that, where placements were bigger than a year ago, all of a sudden we've gone from fewer cattle on feed compared to last year to now more cattle on feed. That really took its toll on the futures market. In fact, if we looked out at that April contract, it's been a good $20 below its high. So we really saw a fairly large reaction. And I think it's more based on short-term supplies with more cattle on feed necessarily than it is, worries about demand. One of the big things in terms of the cattle market and beef market has been we've had surprisingly good beef demand. When we think about prices at record high levels, folks are continuing to buy. I don't think we have a whole lot of evidence that has changed. People continue to buy. So from a demand standpoint, I think there is some, certainly some evidence that folks are still buying, and so we have a demand side that is in good shape. That in terms should be supportive of prices. Yet we look at the live cattle market, and certainly this is a cash market. We've seen some declines. Really, this idea of just plain a little more plentiful supplies in the next couple of months as the more cattle on feed come out of feedlots. And so, really from a supply standpoint, I think that argues for some lower prices, and so this is reasonable. Futures markets, there may be some consideration, are we really going to have the kind of demand we've seen so far this year? But overall, this greater supply. So we got some lower prices where the cash market is responding to lower futures market. And so yet we're still talking about prices that are in the upper 170s, certainly better than last year's roughly 158 at this time. We're at 177, 178. So certainly much higher prices reflecting overall the trend of tighter and tighter supplies. So I think that puts it in a little bit of perspective. We do see some falling prices. And that certainly is affecting calf prices and feeder cattle prices too, where we see a little bit of weakness there. So, certainly as we think about going forward with what Mark was talking about before, I think that provides some support for calf prices and feeder prices. Certainly the prospects of lower feed costs. To tie in kind of all the livestock to what Mark was talking about, one of the things on the demand side for our feed grains, particularly corn, really all over the world, major hog producing countries are cutting their production. We look at Europe, certainly less production there. We continue to see losses on the hog side and some expectations of cutting the breeding herd. Yet we've still been producing about the same amount of pork as a year ago, same number of hogs as a year ago, but there's some expectations based on profit that may change. So I think that livestock side with falling production, really at least on the beef and pork side, less demand for our feed grains in that sense. On the beef side, we've certainly seen some declines in the wholesale market as well. We ended up Friday with the choice box beef cutout, finished Friday $2.93, about 85 cents below the day before, or so we actually have seen that we got the cutout down, is now down under $3, really for the first time really since back early in the year. So, but again, that overall level is certainly well above where we were last year. Again, higher wholesale prices, even though we do see some kind of seasonal fluctuation here going on as well. Thought I'd point out beef cow slaughter. We're sending a lot of beef cows to market. Culling is continuing to move at a pretty high rate, certainly less than it was a year ago. But if we thought about as a percent of the cow herd, and the cow herd being smaller than it was a year ago, we're sending still a relatively large proportion of cows to market. And so really, this idea, are we expanding? No, we're really not. We're sending more cows to market than we would want to if we were really expanding on the cow side. So again, that's a lot of cows going to market. If we looked at auction or some of the national direct data on cull cow prices, prices are falling seasonally as cow slaughter has picked up seasonally. But again, prices continue to be higher than they were last year, even though slaughter is picking up. That's a lot of cows going to market still. Cattle on feed report came out on Friday afternoon. I think the big number in there is placements. Placements again were greater than they were in October of last year. So that's 2 months in a row really of more placements than the year before. You'll notice that October placements were a little bit less than September placements. So I think we've likely put in the high placement month for the year. But really the only way we get placements like this is really we've got to be placing more heifers into feedlots, which means they're headed to beef production, not future beef production. And really with a smaller cow herd, fewer calves, I think the only way we get placements higher like this is where we've got to be placing more heifers. We certainly we have more cattle coming from Mexico, so that would boost those numbers. And then I think it's also likely that we may have pulled some animals ahead. Instead of going to wheat pasture, they're going straight to a feedlot instead. And so that's how we get these placements above a year ago, and really means we've got cattle on feed above a year ago. And this is, I think, that really over the last, starting in the October report and now this November report, we've got more cattle on feed than we did a year ago, which implies some more, maybe more beef production than we expected as these animals come out over the next 4 or 5 months. And so I think that's what's kind of got the futures market kind of backed off a little bit. Is certainly there's a short-term supply component that would suggest a little more beef production, just simply with more cattle on feed, and that would also suggest a little more, maybe a little boost in some local corn demand for those cattle as well, because we just have more on feed than we did last year. So a little bit of boost there in terms of some feed use demand from the cattle side. Thought I'd point out these are look at the meat market a little bit, particularly as we get to the holidays. One of the beef items we tend to see go up in price are the rib, in this case I'm showing ribeyes, and you can see this increase in ribeye values. We're up to, in the wholesale market, $12 a pound over the last couple of weeks, well above where we were a year ago. But with overall tighter supplies and some good demand going on, we've got some higher prices, at least in the ribeye cut. If we looked at a few other wholesale cuts, we would see some falling prices. But seasonally, this is an item that moves at the holidays, so you might see this going on as well, and certainly becomes it's a pretty nice alternative to some other one other big center of the plate item for this week, but sometimes this becomes a pretty nice alternative for a great holiday meal. And so we see this rise seasonally, and this red line being a 5-year average. What you'll notice is once we get past Thanksgiving and we get a lot of the holiday buying is done, even to get to Christmas, then we see those wholesale prices tend to fall off once we're sort of past the holiday buying. You know, if you go to your grocery store and you snoop around the meat case like I do just to kind of see what you see, I think one of the things that I feel like I've noticed since the pandemic is we see a variety of different cuts. I think we see some real creativity in the meat case as grocery stores are trying to move different things, and they're trying different products. It seems to me that there are fewer different items on the meat case than maybe we used to see. But, you know, we're actually seeing some different ones. And so I took this picture this weekend. Actually, I didn't have my phone, so I got my wife to take this picture. I've never seen this cut in the store like this before. And what you'll notice there, if you can read down at the bottom, the name of this is Thor's Hammer. So if you're a fan of the Marvel movies, you know, Thor's got a hammer. And this is a beef shank. So if sliced up, you might turn this into ossobuco. But this is the whole beef shank that I guess you'd cook like a roast, and they've taken the meat off the bone, a part of that, so you got a good handle on it. If you see those tomahawk steaks, well, I guess this is Thor's hammer. And so this one really made me laugh. I had to yell over at my wife to come over and take a picture of this, which she really didn't want to because this was wasting her time. And but I thought this would be pretty good for today. But this was in our meat case yesterday at our local HEB. I thought this was a pretty interesting, different kind of cut, different kind of presentation than I've certainly seen before. But yeah, you know, $6.99 per pound. This is a prime. I guess it'd turn into a roast for a whole beef shank. So anyway, pretty interesting. I think we see some different cuts going on and different presentations for the holidays. I think that's an interesting one. Since it's Thanksgiving week, I thought I'd just put turkey prices up. I've had a number of phone calls in the last week or so about turkey prices and where are we. These are what I'd call wholesale turkey prices. Boy, way off of last year's record, which was, you know, really affected by avian influenza that hit us and drastically cut supplies. This year, turkey producers have responded to record high prices. They're producing more. Production this year is up about 4% over last year. But, you know, in the long-term trend, it's all, you know, while our production is greater than last year, it's about the smallest year going back a number of years. So the long-term trend is less turkey production, but we're rebounding from last year's disaster. You might have seen in the news that we have had over the last 3 weeks or so a number of incidences of high pathogenic avian influenza, several in turkey flocks. But they've sort of hit, at least in the aggregate market, a little bit too late to really affect prices. So I think one of the things you might see at your grocery store as folks are talking about Thanksgiving, at least some lower turkey prices, I think, at the store than maybe what we're used to, and maybe a few more specials out there. Oftentimes I make sort of a pitch for Southern Ag Today. Tomorrow's article on Livestock Day for Southern Ag Today is on turkeys and sort of what we're seeing in terms of prices, both at retail and at wholesale compared to a year ago, and that perhaps this is, you know, I think there's some opportunity for some savings for consumers. And so it's kind of nice to see you know, from a consumer standpoint, it's pretty nice to see an item going down in price. And I think we certainly see that in the turkey market. And so really, gosh, with that, that's really my last slide, Pancho. So I'll stop sharing and take any questions anybody might have. And if we have no questions, then I certainly want to make sure I hope all of you have a fantastic Thanksgiving holiday.
Thank you, David. That was a great presentation.